Well, hello there. Welcome to the Pruskop Podcast. My name is Megan Prusko, and I'm a residential and multifamily realtor here in Edmonton, Alberta. Today, we are talking to Jason Watson, who is a very well-known private lender between Calgary and Edmonton real estate investors. We talk about what you can expect if you are looking to lend money yourself and the systems and processes that he does to make sure that your best interests are covered and that your money is making money. That's the whole point. If you're looking to learn more about real estate or investing, then please drop a comment below on the content you're trying to find, but nobody seems to be covering. If you do enjoy this episode, then please like and subscribe. It goes a super long way. I hope you enjoy the conversation just as much as I did. I'm so glad that you were able to meet me on this. I think this is such a really cool topic that we're talking about. So I do want to ask you, Jason, what is your career background and how did you land up in private lending?
It started out, I used to lend money when I was a kid, actually, a little bit in school. People would joke about my little black book. And it obviously wasn't big, like $5 for a big bear, stuff like that, if they even exist anymore. June of 99, I went and got my real estate license. And I started selling real estate in 99. Really got going with a mentor in 2000. And he specialized in foreclosures and new home builds and just regular sales as well. So I got a real good taste of the foreclosures. We had master accounts that were coming out of Toronto for all of Alberta. And with the foreclosures, some of them were in good condition, some of them are not. So that kind of showed the finance or the repairs section of it. So then after that, what I did, we parted ways after a few years and I opened up a real estate office. And by the time of buying two and merging with one, I had peaked out at about 206 agents. And during that period of time, I started advancing commissions. So really what it is possession 60 days away. They could use the money for marketing or something right now. So I would advance a portion of that and then just collect it with some interest after the possession happens. So that really got my lending going with my interesting. And then I got my word out that I had money to lend. So from there, I got into real estate investing and dropped my real estate license. And what I started doing a lot was the seller finance, rent-own stuff. And I did that until 2018. And the reason why I stopped in 2018, that's when the banks start getting more strict. They wouldn't allow refinances up to 90% anymore. They would stop at 80. So it really started squeezing out that network because when I did the seller finance or the rent owns, I wasn't after grabbing the property from them. I was after getting a higher monthly payment just on the cash flow basis, let the problems, repairs, maintenance all to them. And then after the 2018, once those laws changed within the lending parameters, that's when I really got going 100% with private financing. And the rest is history.
So you've been doing this literally since you were a child. I think that's funny that you were lending money when you were little for Big Bears and stuff. I still remember back in grade 1, I lent 50 cents to buy a candy cane and she never paid me back. And I was joking about the interest on that. But yeah, you've been doing this for a really long time. How long have you been officially a private lender full time?
So officially full time, honestly, I've been lending since about 2005. But full time, no interruptions, no more buying real estate, anything like that. About 10 years is what it's been. I ended up getting my mortgage license, I think, it was 2014 or 2015 or something. And that's when some of my investor groups started coming in and were investing with me and using whether it was their TFSA, RSP. Back like 10 years ago, it was difficult with the TFSA because they were so small and they didn't let you put much into them. But that's when it really got going. And I've got a large network throughout Alberta primarily that send me their files. And then within that, I've got a group of investors that I work with that will fund some of them, I'll fund some of them, and so on.
I'm on the Calvin Realty team, and anytime that we need a quick close to get the deal done, then you'll just private lend and bridge it, and then we can close with CIBC or whoever later. But today we're going to be talking mostly from the perspective of the lending side, but what other services do you provide that fall in your category?
In some cases, we'll take care of the payments. All of the missed payments and stuff, I personally do myself. for two reasons. There's a way to go about doing it. And the second reason is it keeps me sharper on the approvals. Because if I'm going to back it up and say, hey, I recommend funding this particular transaction, if I have to go and clean up a monthly missed payment or something, it just makes you tighten things up a little bit and then makes it also easier for the investor. Because going back to that 50 cents, with the interest that you mentioned, the reason why you didn't pay is because you didn't have collateral and there was no what's in it for them to care to pay you. And
Yep.
that's actually the key thing when it comes to this lending. Really, what we're doing is we're lending the house money and then we're counting on the borrower making payments and their credit last. And when I use the words counting on them making the payments, if there's enough equity sitting in that home for protection, as well as it will affect their bottom line with either their personal net worth or their monthly income, that's when those payments they get paid a lot more smoother and they care more at that point. And then you get your 50 cents.
Yeah, that 50 cents. I was joking about that.
Well, I get it. Once you start lending money, it's about principle, right?
Exactly. I'm
Yeah, for
curious,
sure.
what is one of the most satisfying deals that you put together?
Oh boy, there's all sorts of them. A couple of weeks ago, for example, we did a transaction in 18 hours, and that was between signing the lawyers. It was a Thursday afternoon. It went out. Just a minute, was this 18? Anyway, Thursday at 4 o'clock, the docs went out to my lawyer, and they were signed and funded by noon on Friday morning. It causes a lot of stress within my circle, but it's pretty cool to be able to do something that quick. And in those cases, that's where maybe investors or somebody that doesn't need private as often will come along because of the speed. But a lot of ones that I enjoy, there are the renos where people will do a burr or they will do the reno and flip. New home closings where they'll come in and maybe a year ago they bought at a lower price and now they're going to quickly close it and flip it out. I don't know, it's a variety, to be honest with you. And when they work on both ends, that you can fund them and make a nice return, and then you do get paid back, that's really the name of the game. And what you're
On the
after.
flip side, I imagine you're dealing with a lot of properties that might be iffy and there can be things that go wrong. So, what is a project that you worked on that did go sideways and how did you try to remedy the situation?
Okay, so I haven't had one that's gone sideways. And the
Really?
reason the reason why I haven't got nothing's gone sideways is because if it is a reno, let's say it's a $400,000 property, today's value as is, and then the after repaired value is 550. What I'll do is sometimes I'll do the I'll do the loan approval based off of maybe 75 or 80% of the 550. The advance is lower than the 400. So again, there's a what's in it for them to keep going. Now, the reason why I haven't had a failure is twofold. We plan the reno out. Sometimes they will take a little bit longer. Sometimes they might ask, hey, instead of this advance after the garage roof, can I tie it into this window or this bathroom? So there's some flexibility we do. But the main reason why I haven't lost on one of those is primarily we look at the property first. And then we look at how is the ability of the borrower. Is this their first one or last one? And then we look at the price point as well, because sometimes those cheaper properties or condos, that's where you can get into trouble versus a house. And I guess my real estate background tells me what will sell and what won't and how markets flow. Yeah, I'm going in the circle, but if that kind of gives you an idea of why there hasn't been a problem on the exit. But like I say, there's some adjustments you have to do in the middle from time to time. But when done right and the equity's there again, generally they can be listed, sold, and gone, and they make their profit.
So it sounds like you're very involved in these projects. It's not some rando asking you for 80K so they can flip a house and you're like, yeah, sure, why not? Like you are independently basically underwriting these deals yourself to make sure that it's actually a good idea for the borrower, it's a good idea for the lender, and of course it's a good idea for you.
Yeah, yeah, for sure. Because if it works out for the borrower, they're back. We've got some borrowers like we're pushing 7, 8 times that they're
Wow.
still renovating homes. So obviously they're being profitable at that point. And then it's easier if you get a happier client from a borrower standpoint. The deals come a little bit more simple. But also, if I can keep the investor satisfied with everything, where they're not as stressed, you get an easier yes, and it just makes things go a lot smoother when it's done properly. That's the key thing.
And obviously, when you're lending money out, you're getting a certain interest rate for lending your money. But I'm
Mhm.
curious, how do you get paid? Is it a flat fee? Do you get a percentage of the spread?
So sometimes there's a percentage on the spread if we're going to administer or carry the payments or anything. And that could be on the basis of if I do a first, second mortgage where I'm in second, and then the requirement is for me to make a payment on the first. Generally, what it is fees. So we'll charge the borrower X amount of percentage of a fee. It comes out of the total loan proceeds at the lawyer. And then the borrower has to pay it back when they pay back the total. So for the most part, there isn't really a cost to the investor lender component, but there are, again, it depends on the case by case, because in some cases I do offer financial assistance to our investors and lenders, and in those cases obviously it changes a little bit.
And for the people that are wondering right now, why would I privately borrow if I could just go to the bank? What are the kinds of people that you typically assist with on the borrowing side?
So there could be a variety. I'll go with the worst one first. I've got a foreclosure I'm working on right now that we're about 67% loan to value, meaning the total debt is 67% of the property's value. So it gives me a lot of equity. In that particular case, they're selling another property that should come up with $150,000 for them and pay down my debt, get me under 50%, where it's pretty much a no brainer. Because again, we're basing things off of collateral and equity with the exit. And then within about 6 months to a year, their credit should be enough that they can go to a B lender and take it out. Now, the other thing is, let's go to a brand new home where people's credit is mint condition. They're going to close on it. They might put a kitchen in the basement, list it, and sell it within 3 to 6 months. The banks don't like those. The banks want the long term because of the cost of them to underwrite the deal and what they're after, the long term cash flow situation. So a person that's flipping a brand new home, they could very well get approved through TD Bank, for example, but those mortgages now get registered on the credit bureau. So if they see a mortgage go on and let's say it's paid out in 3 or 4 months, there might be forgiven with the right story once. But if they see it a couple times, the other banks are going to say, hey, this guy's a flipper. I'm not interested in doing this.
Just don't make their money short term, they make their money long term.
Yeah. And they just want to rinse, repeat monthly. The same thing that an investor lender that works with me, just give me my payment, leave me alone, I'm happy thing, right? Now, the other thing that you can see is the mediocre, you get self-employed. Self-employed will claim a lot lower tax. And then as a result, the bank says, hey, you're not as good. But meanwhile, you are. So there are particular lenders that will look at 6 months worth of bank statements and say, okay, you might only be claiming 40 or 50,000 a year, but I see $10,000, $15,000 a month average that comes through your account. Those particular banks will they'll look at it and they'll approve you based on a certain percentage in loan to value. And then they will also be the ones that allow second mortgages, for example, to go into place to close the transaction. And that also goes for rentals. Sometimes they're a little bit sticky. So where I'm going with this is, again, depending on the banker, how the individual borrower claims their taxes, or do they have too much debt? That's where it'll come into play, whether services of a private lender come into that are needed, right?
I like that you touched on self-employed because as a realtor, of course, I am. And for example, I can't be approved for a mortgage right now. I don't have a 2-year track record. So even though I'm okay on the deposit and the financial side, I don't have the 2-year runway that the banks require in order to feel comfortable lending to me.
Yeah.
So you could be a solution for me.
Yeah, for sure. And really, in your case, depending on what your current situation looks like, it could be the banks you're talking to. There might be a B lender. I could put you in touch with somebody that gets you a B lender, and that B lender might say, based on what I see, I'll give you 65% of the property's value, and you might be short the down payment. So you might have to borrow 10% or 15% to get it to 75, 80% loan to value total. And that's where the private comes in. So that's a good case to help out somebody that's credit's good. Yes, their income's low just because they don't want to pay income tax is what it boils down to. So then it comes into play. And when you really look at it, as much as the interest rates on private, like with me, they range from about 6 to 16%, depending on high risk, low risk. Are you in first position, second, or third? Is the property in the city, outside? But anyway, with this, let's say the house you're going to go purchase, you have to claim $120,000 or $150,000 worth of personal income tax and pay 40-50% of that to the government. Sometimes it's cheaper keeping yourself down at that 40-50 mark and paying a higher interest rate because your net dollars are are further ahead. So a lot of when it comes to lending and then borrowing money and so on, it's a math game. If the math is there, the math generally doesn't lie. Obviously, there's risks that come into play with the personality of a borrower or marketplace or something like that. But for the most part, you watch for that, you monitor for it.
What
And
I
a lot
love
of
about what you're explaining right now is this is the very reason why private lending is also called creative financing,
yeah,
because you just came up with how many solutions for my specific situation. And there's so many more options out there than just going to CIBC to get a loan. But you don't know if you don't know. So that's why I think your job is so interesting, because you know all of these alternative options for people that they don't even know is an option for them.
yeah. Yeah, for sure. And don't quote me today, but I didn't look too long ago, like a year or two or whatever it was. There's 200 banks in Canada. It's just whether there's the big five that we all know about and drive by, but then there's all sorts of ones that work within them. And as much as RBC, for example, might not lend you the money, they own one of the banks that will lend you the money. They just do it at a higher rate and change the terms. Because the truth of it is, if you go get a CIBC or TD or whatever, CMHC mortgage, where they put 5 or 10% down, there's actually more risk in that transaction than the guy with terrible credit that puts 50% down. Because the thing is, if the guy with 5 or 10% fails, loses their job, has a health problem, whatever could happen, and they got to liquidate that property, yes, the banks are in good standing because CMHC has guaranteed the loan,
Yeah.
but CMHC will still come after you. Where in the case of 50%, as another major example, really the house is going to sell. There's going to generally be money left over, and it just removes the risk. Is all there is to it.
Yeah, I am excited to dive in on how exactly this works. So, before we dive into the steps and the mechanics of it, can somebody lend through their TFSA, RRSP, other savings accounts?
Yeah, absolutely. When it comes to the RSPs, the TFSAs and LEARs and so on, there's a trust administration company that generally handles those funds. It's Olympia Trust, and you can see them on the internet. They're huge. Canadian Western Bank used to be a competitor, but now they've been bought out and it's merged as one. And really, at the end of the day, you take your TFSA, your RSP, you pull it out of the stock or whatever you have it in, or if it's liquid, you transfer it to Olympia Trust account, and then from there, they legally administer the funds from your account to the lawyer's trust account for funding and back. And that's what allows you not to have the tax trip, because it's all processed that way.
And to clarify on that, like if you have, I don't know, 50 grand in stocks in your TFSA, you're liquidating the stocks, but you're holding that money in your TFSA. You're not pulling it out of your TFSA, you're just transferring it to another TFSA account.
Yeah, 100%.
So you're not reducing your contribution cap or anything like that.
Yeah, that's exactly it. And when that money leaves your TFSA again through Olympia Trust, for example, it goes to your lawyer's trust account. When payments come back from the borrower, it goes directly into Olympia Trust's account, which gets funneled into your personal TFSA account.
That's so cool.
Yeah.
All right, let's get into how it actually works. So I'm going to pretend that I have $100,000 that I want to bring to you so you can lend for me, because I like the idea of investing in real estate, but I don't know if I want to be a landlord. And after having money in stocks for a while, I feel it's volatile. So I think you could be a good alternative. So can you run me through what fees should I be expected to pay for? How does it work? And just hold my hand through the process. Teach me.
Okay, so really we'll talk about the asset first and the protection, and then work its way through to the funding moment. As I mentioned before, you're lending the house money and then the borrower second. So number one, you want to factor in what's the price point of the home, where is it located, how desirable the home is, not from a personal, emotional standpoint, will many others like this home. And from there, based on how desirable that property is, whether it's Timbuktu or somewhere in the city of Edmonton in the right location, determines how much equity we want to leave in that property. And when I use the word leave, the equity from the standpoint is we've got to count on them not making a payment from day one. And if we have to fight and foreclose to get it back, after the interest arrears, the legal costs, any tax, any possible arrears that way, and realtor fees to sell it, do we have enough equity to get out whole? So that's the number one thing we're looking at. Now, when we also go to look at equity, you take a house in Edmonton for like $1.5 million versus a house in Edmonton for 200,000. There's a drastic difference when you go to 80% of both of those numbers. Because when you go to 80% loan to value being 80% of 200, you've got $40,000 worth of equity. Talk about negotiation, a sale, a realtor, foreclosure costs, you're already in the hole. Now, if you go to $1.5 million at 80%, yes, you have $300,000 worth of equity, but the problem is you still have those expenses and the market's more volatile at that point. Overnight in a negotiation, you could lose $75,000 or $100,000.
What
So
I
where
like
you
that
want to
you're doing right now is you're teaching me the worst case scenarios on what to look out for. You're not teaching me like the pros to look for, you're teaching me the cons, which I think is a lot more valuable.
Yeah, the pros show up when it's done right. You check your
Mhm.
account on the 3rd of each month and say, yes, I got my payment. I don't have to contact Jason with a problem. And then you just onward. But where I was going with the houses, so what you want to look at, whether it's Calgary, Edmonton, Red Deer, or whatever, you want to be in that sweet spot. You want to be like between 400 and maybe 800, depending on what the marketplace is when we're discussing this, because that's where the bulk of the buyers are. That's where the bulk of the qualifiers are, because the buyers are there, and where we can move the product quicker. The other thing is when you're around that 400 to 800 mark, generally there's an income that will match or be close to what the 80 or the 20% equity component in those houses are. And when I say that, when the equity in the property will match a year's income, they'll treat that equity with a lot more care than the guy that's making, $1 million a year and has $100,000 worth of equity. It's nothing for them just to replace that money. But if you have somebody making 150, 200,000 a year with 100,000 equity, it takes a year really to get that money back. So that's where they'll care a little bit more, in the sense that, and I'm not trying to be negative saying they, and pardon me for saying he, she, and everything. I'm a 1900 baby, so
1900s
sometimes it's
baby.
difficult with the program. But anyway, with that, that's where you want to match it up, that the borrower is a little more strong to make sure they care about the equity you've already built to protect yourself. Because again, everybody fixates on it. If the bank said no and the credit's no, why do I want it? But they're going after a mass group of people that is easy for them, and they're able to move billions of money, where we're looking at a different niche. You're not moving as much money. There's fewer deals. It works better for the smaller market.
Yeah. So
Yeah.
it sounds like when borrowers contact you and they say X is my project, then I'm assuming you evaluate it yourself using those terms that you have already, the
Yeah.
qualifications.
Yeah.
And then what I'm assuming happens is you would then come to me and say, Megan, I have one of 3 projects. This is what's going on with them. I recommend this one, but choose which one you want me to lend your money on. Is that how it works?
Pretty much. Like, we'll have a talk and just make sure we're both on the same page, first of all, because primarily when this money's getting lent, it is going to people in need, but not in need. But with that said, you want to be comfortable lending it just in case they want it longer for some reason. And that's what I'm looking at with my reputation. People know that it's safe money, and they can count on it, number one. So what we do is we figure out that we're compatible working together, and then how much money you have to work with, and what kind of transactions or deals or sizes that you're looking for. Because some private lenders, they'll come in with their $100,000 TFSA, but they might have $500,000 in RSPs and another $1 million cash. In their cases, maybe they do larger mortgages, or they go in first mortgage position, take a lower rate, but get more of their money working. Where somebody that might be a little tighter on funds, they might be forced to do a second. So then at that point, are we doing it on a house in the city? What part of the city? What price point? And then who's in first does matter. Because if it's a private mortgage in first, that could add sometimes a little more risk to the second versus a bank.
Can you explain the difference of being like first place, second place, third place on mortgage on title? Like, why is that important if I'm in third place versus first place?
Yeah, absolutely. So at the end of the day, again, the equity matters first. But let's just say you're the only mortgage on the title right now.
Okay.
So you're in first. What that means, when they go to sell the property, the first mortgage gets paid out before they receive their equity. If you go and put a second mortgage in place now, the first mortgage will get paid out first, and then the second mortgage will get paid out. Then the borrower will receive their equity. So first, second, third position really is who's getting paid out first and who has priority. When you're in second, obviously you have more risk because you have less equity and you have to worry about the person in first or the bank. And the reason why is because if you're getting paid, but the first mortgage isn't getting paid, you need to know that happens because the first could start foreclosure where it catches you off guard. And then when they start,
what would happen if I was in second place and there was only enough equity to pay out first place? What happens?
You're going to lose your money. And that's why you want to watch the equity right to begin with. And when I go
would my only recourse be legal action?
In Alberta, you don't even have that. What the mortgage is really it. So going back to the 80% loan to value scenarios I was talking about, and what that is you take a house that's worth 100 grand and you have an $80,000 total debt mortgages on it. That's 80% of the value. So loan to value. So when I look at those sweet spots of 400 to 800, generally it has enough equity to handle a real estate fee, a foreclosure cost, and any arrears that might be showing up on the first, because all of that eats up the equity as it goes, right?
Yeah, those closing costs, those realtor commissions too. I tell you.
But yeah, like equity is the most important to this game because that's how you get paid, and
that makes sense. So let's say for easy numbers, it's that $100,000 house. If I'm first place and I'm putting 10 grand into it, and that's okay. But then in the second place, if they were to get a mortgage for, again, $100,000, which I doubt would happen, but then second place maybe will only get 90 out of their $100,000 back.
Yeah, or you go and take that $10,000 example that's in first, and they go and ask for $100,000 loan. Now you've got $110,000 worth of debt on $100,000 property. Unless they are mint condition going to pay you, chances are it's not going to work. You're going to go into foreclosure, and you're immediately in the hole. Ignore the fact that you're already 10,000 over a value, but you're immediate in the hole just on the basis of there's just no equity to sell the house. Is really it.
If I am lending money through you, are there fees that I need to be aware of to get this process started?
So when you do the Olympia Trust, there are funding fees that they'll charge you a few $100 to fund the mortgage, and then there's a bank account fee for them to do collections. Just if you were at TD Bank, it's a little bit more though. And then if an NSF were to happen through Olympia, they'll charge you like $50. But on the other end, I'll charge them much more for two reasons: to make sure you break even or make a profit on the NSF, and also to motivate them to make their payment. Because I had somebody that I lent a considerable amount of money 2 years ago, and it was October 31st, actually. I got a phone call from them in front of the car dealership. The car dealer said, "Oh, his payment's all current and everything fine?" And I said, "Yes," and it truly was. And then November 1st, the payment stopped. And I had problems with them since. So they were playing a game on let's catch it while we're current because we're going to use our money to buy this vehicle. But the other problem is it was a $3,000 payment and there was only a $100 NSF late fee. So that's like nothing for $3,000. They'll go and pay other bills first that have more of a penalty. So now in that case of $3,000, I would do like a $350, $400 NSF fee. Now you go to court and foreclosure, you're not getting it. And we're not getting in jail. We're not going to jail for charging $350, $400. But what it is, it's a motivating factor to make sure that they make us the priority again, right?
How do you verify the borrowers? Do you verify the borrowers as people, or do you verify the projects they're on, or both?
Both. And if it's a corporation, we verify that they own the corporation. So I do the first version of it. And then when we go to close, there's two lawyers, always two lawyers. There's the lawyer that's going to work for us on the lending side. And then there's the lawyer that works for the borrower on their side. So our lawyer confirms through the lawyer or the legal closing that, yes, these are the people, yes, they own the corporation and so on. Like we can see it. You pull a registration form and so on, you can see their names, but it's just that extra level of due diligence. Now, what I was going to say before is, let's say you go and lend on a house and we're at 80% and everything seems fine. And then they destroy the house. It just gets totaled and it's gone from 500 down to 400. You've got no equity in it. You're worried you're going to lose money on it. There's two things that happen. Foreclosure goes a lot quicker because, for one, there's no equity, so there's no risk to the borrower anymore. So you might as well just give it to the lender. The other thing is, in my circles, I know people that would love to have a beat up house for 400 that they can go and sell for 500. If I had to do this, I would just connect over to them and say, hey, I got a financed house for you. Have at her, flip it, make your money, and we're on our way out. So that's another exit strategy for not losing money. But with that said, I haven't had the problem. But if it happened, that's where you gauge off of it. Now, if you went going back to that $1.5 million example, if we were to come down 300,000 and they were to destroy the house, but a higher end home like that, you've got to spend much more. And even doing the reno, it's going to be difficult breaking even, right?
Yeah. If I'm lending, how long is my money locked up for? How long is the term?
So the terms that I work with, they're 3 to 36 months. 3 months, go into the new home example that I mentioned, they'll close and flip, or just any property they're going to close and flip on. Generally, those will be open after 3 months because going in, they know that the plan is to get out. And then I've had two today show up that they've asked for longer than 12 months. 12 months is what I'm going to start at. If everything goes smooth, chances are I'll renew them with the investor lender, and it could be another 12 months. But I don't want to lock in too far out of the gate because we don't know what they're like. The thing is I can't foreclose on late payments. I can only foreclose on missing payments. So let's say they become a couple months behind 6 months from now, and I want to foreclose, but they bring up those two payments. I've got to go back with the extension of the term. So we just don't want we want to control it is really it.
That's
right?
really interesting. I didn't know that.
Yeah, and it's not to abuse the people, but it's just when you have the control and you're running a little bit more, you can guide on where we're going to go with a plan of action. And with that said, I've got 24-month loans out there myself right out of the gate, but the equity's strong, the situation's strong. It might be anything from a divorce, or they're coming like yourself. You're new to real estate, so you may not need private for this example, but they might need private for a year and a half until the banks start looking at the 2-year cycle. When we know that and it's a hard worker and so on, we'll give the 18 months because they're going to need it anyway. And we have an exit we can probably count on.
Yeah. So let's say my $100,000 example, let's say I want to do a 6-month term. So a really hardy flip that they're doing. Okay. What interest rate range could I expect to get for my money?
So that depends on if you're going to be in first position or second position, or if you're going to do just a large first. Where I go with this is the first mortgage rates are generally lower because they have more equity. The second mortgage comes in to bridge a little bit more of a dollar gap, and they take more risk, as we mentioned, less equity as well as more risk because you don't know the payments are made in first. So to cut to the chase, it could be anywhere from like 10 to 16%, to tell you the truth. Again, it depends on if it's 6 months, 3 months, 12 months. The other thing is sometimes we'll do loans open after 3 months. And what that means is after 3 months, they don't have a prepayment penalty. So that's cheaper to the borrower. In those cases, we increase the rates to be able to benefit to the investor a little bit more. Some of the longer term ones, we might give them a 12-month term with a 3-month prepayment penalty. At that point, if they pay out in 6, 7 months, they owe 3 months worth of interest as a penalty to the investor. At that point, in those cases, the rates will come down to help attract that transaction. But again, we want to keep the returns as high as we can for the investors, obviously.
And if it is a longer term, am I getting more interest or less interest?
That again depends on what the transaction is. I've had deals that have gone, like I had one in Calgary that went on for 5 years, and I was 14.45 or 14.75, and 2 years in they actually went bankrupt.
What do you mean 14.75?
14.75% interest rate. And it was on 100,000. Sorry, there's just the slang. There was 100,000 that I lent them. And like I say, it was 5 years. I mean, it was 14.45%. And I had one missed payment from them by a day, and she panicked. And I'm not saying, oh, great, she panicked, but it shows how important her home was to her. And within 2 years of giving them their loan, they went bankrupt and shed all their debt. And when bankruptcy happens to a mortgage lender, you're a secured creditor. You really don't have to deal with those problems. And this is as of today's date. But you don't have to deal with the problems of, say, a promissory note or a credit card or something. And a lot of that comes in because the banks lend a bunch of money and the systems protect who's in control. So in that particular case, not that I like that she went bankrupt, but I liked the loan better because at this point, I've got my equity still. The credit is bad, that there's not going to be any more credit cards that show up. The debt payments have shed, and now it's just me. Like I say, I had 5 years. It was just ticking along, and we would renew it each year. And yeah, it was a great loan.
I like that
Now,
you focus a lot more on red flags than green flags, but have you noticed a pattern of green flags to people, like brand new clients that you meet, where you just know that they're going to be a good borrower or lender?
the lender, again, that's just, we talk about goals and what your target is. Do you need this money out? And you were asking, before I get into this too far, or this answer, you were asking about whether their money is locked up. Like, it is generally locked up in the term, but I did have somebody that had some health issues at one point, and we got their mortgage bought out so they could get the cash, and then they didn't have to worry about it.
Do you just find somebody else to take
Yeah,
over?
it was just within my network. Yeah,
Yep.
we helped them out. So it's available, but we just don't want to take advantage of it, sort of thing. Just because there's commitments to the borrowers. But when it comes to the borrowers, if there's the green flag and everything's good, sometimes it's a debt consolidation that they're going to eliminate 3 or 4 credit cards. Their mortgage comes due in a year. I'm seeing a lot of that right now, actually. The COVID mortgages are going to start coming due in a year. And those rates are like 1 point nothing percent. So a lot of people are wanting to take a second mortgage of X dollars, pay the higher interest rate to get their credit score beef back up because they had to consolidate debt, and then they'll renew and pay us out. But when you look at the effective costs of, say, a $50,000 second at 12 or 13% and a $200,000 first at less than 2%, it's actually cheaper just taking the private second. So in that particular case, that's where there's a whole stereotype. You take private money, you must be terrible. But no, it's actually financially smart from a calculator standpoint to do this. And because of all this inflation and everything that's going on, we're finding good credit people that are in this situation, but it's bringing their credit down a little too much. Even though they're current on everything, their debt loads are too much. It's bringing the score down. So when they do want to consolidate and refinance, whether it's a year or whatever from now, the banks will say no, which is.
Can you explain what you mean by debt loads? Because if you have good credit, that means that you're not in debt. But what do you mean by debt load?
You can have debt, you can have good credit with debt, but the way the credit gets rated is, let's say you've got a credit card for $10,000. If it's maxed, you have no free money to go or to borrow. So they're saying you're at risk because why aren't you paying down some of this debt? But if it's at 50%, they'll bump the score because now they see that there's a cushion room. You are using your credit, which they want you to use, obviously, to borrow the money. So that's how it gets gauged. It's not on your mortgage. Your mortgage is based on payments. But when it comes to credit scores, again, it's lease payments, credit cards, line of credits, and so on. So if everything's maxed and new, that's when your credit score is going to come down. But if it's paid off or 50% or lower balances, that's when your credit score will really bump up because now you've proven you make your payments and they're really happy. So with that, we'll go and put a debt consolidation loan of a second mortgage. It doesn't go on the credit bureau, brings down the debt loads, balances, I should say, instead of the loads, boosts their score, which helps them do their refi, or whether it's a year out or whatever.
That's such cool stuff.
And I've had loans that have only been a month. Like, I don't really give those to investors because it's not worth their time to look into it, put the money up and so on. But really what it is, it's an income. They finished their income tax. They had a bill for $32,000 or something. So I lent them the money, got the tax the tax's current bank showed up and gave them the refi. So there's those scenarios as well.
So if I'm lending money, you mentioned that I obviously get interest payments. Do I get the interest payments once a month, bi-weekly? Do I get them at the end of the term? How can I watch my money grow through this process?
So those can all be variables that could happen. You could go bi-weekly, monthly, accrue it all for the end and then get paid at the end. You could have it prepaid for the year and then they start making payments in a year or they pay it out. When it comes to me, 99% of the payments are monthly and I have them on the first of every month. The reason why I have them on the first is because then we can get it all out of the way in the first few days, who's not paid, who's bounced and so on. And with the accruing and not take a payment, I don't remember the last one I did on that. Because the way I look at it is if you're not going to make the payment, then let's get paid up front and close this term so that we're covered and now the rest is on you as the borrower. And let's say that we're at 875 or 80% loan to value, again, being the total debt divided by the value of the house. I will take those numbers and go less the prepaid interest. So it's not like they borrow 100 grand and they're going to owe 112 a year from now. They still owe 100. They're just not going to receive. They're going to receive like 80,000 after closing costs because the interest is prepaid. And I've got one of those that we're working on right now. They've got a bunch of debt. I think they need to consolidate. Sometimes people don't talk to me as much about those things because they're worried. I can just read between the lines. And I offered to have it prepaid because I think they're going to break if they take this on. Now, they happen to have a property down in Brantford that they're going to sell, but they told me the house is worth $890. It's been on the market for 2 months at $850. So as a realtor, all the homeowners think their house is up here and the buyers.
It's their babies, right? They're the most
exactly.
precious house out there.
That's exactly it. But based off of that, I need to do a little more research, but it tells me they're not in line with their values and objectives. So it could cause me a little bit of a problem for 3, 6, 12 months because they're being so slow on the sale of one thing. Anyway, I'm rambling, but goes back to due diligence.
Yeah. So you mentioned that if people don't pay back, that you might have to close it quicker so that you can protect your lender and then yourself. But what happens if the borrower wants to pay it back sooner than the term end date?
Okay, so let's pretend it's a 12-month term.
Yeah.
If we know if they're going to flip a new house and we know that they're going to close on it and just sell it, to give flexible terms with a higher rate, we'll make it open after 3 months. So let's say it sells in 2 months, they're going to owe you 1 month worth of extra interest. If they sell it in 4 months, then it will be daily interest that they still owe. Now, if they take a different loan that's a 12-month term with a 1, 2, 3 month penalty or whatever it could be, and they pay it out early, they'll owe that 3 months worth of interest to the lender as the penalty, just like the mortgage you would have with the bank. They might do an interest differential that you owe us X dollars for getting it out early, or we want 3 months interest, or it just depends on the terms of it. But mainly with me, it's a 3-month interest prepayment penalty on a 12-month. If it's already planned to be a short-term loan, then at that point it might be open after a certain amount of time, somewhere in there. So renovations, like renos and new home flips and stuff like that, generally it's a minimum period and then open after. These other ones that I talked about that need to consolidate, they're in it for a year anyway. And the other thing is they are a little risky. So I'm going to put the 3-month penalty on there as a bonus for either myself or whoever has it as the investment to make up and balance it a little bit.
Yeah. And then worst case scenario, let's say I lend my $100,000 to this flip project, but they use my money for construction and they have to foreclose because they messed up on their projections. So what happens if I've lent on a property that forecloses? How do you help me?
Okay, so when it comes to a renovation, there's already existing home there. So we're working within the reno, whether it's a roof, windows, drywall, kitchen, all that sort of jazz. So it's controlled in a sense. When the kitchen goes in, now we'll give you the money. So it's always afterwards.
Okay, so you do draws then.
Yeah, it's on a draw and it's you put your risk up first and then we'll show up. With a building like construction in that point, those are some of the most risky ones because now we're counting on a building to actually exist with that money, and you might be drawing more funds that could get allocated somewhere else.
Mm.
So if you go and do a renovation, the place is in shambles, there's not a lot of as-is equity, but there's a fair amount of projected after you get the reno done, those foreclosures go very quick. And the reason why is there's more risk to the lender than the borrower. There's nobody living in it, and you technically can't live in it. So that's the bonus to the lender in those cases. The negative, though, you've got a house that you can't quickly just rent out. You've got to find somebody to fix it or fix it yourself and then go on to the next page. But like I said earlier, if you have somebody in your back pocket that can do that, then that helps eliminate the risk.
If I lent that money on that property, then obviously my name is first on title in this case, let's say. So if the borrowers aren't able to pay me, they are foreclosing or forfeiting the right to that property, then that property is under my right to sell to get my money back out? Or how does that work?
Yeah, so with the foreclosure, if there is a chunk of equity in there, then you're forced to sell it, get paid out, and then the balance of the funds will go to the borrower. If there is a lot of equity in there, chances are somebody's going to show up and just take you out.
Yep.
If there's no equity, let's talk about the foreclosure process. So they've missed a couple payments. They're not communicating. You can see where it's going. We contact our lawyer. That's a foreclosure lawyer. There's closing lawyers and then there's foreclosure lawyers. You want the ones that specialize in each. So Jim is the foreclosure lawyer I use. So Jim will go and do a demand letter and he'll send it out to the borrower. And generally what that demand letter says is you owe X amount of dollars, arrears payments, his demand letter fee, and the balance owing of the mortgage. You've got 10 days to clean that up and pay it out, or we're going to court and foreclosing. Usually you don't get paid out because 10 days is very tight and there's arrears.
If they had that money, then it probably wouldn't have gotten to this point.
Yeah, exactly. So then he'll go to actual court and he'll go for a statement of claim. That could take anywhere from 30 to 45 days. I'm going off of equity in this standpoint, that it's going to take a little longer. No equity, he can have it done in a couple of weeks. But there's equity we're going to treat in this example. So that's 30 to 45 days. Once he has the statement of claim, the borrower can argue and play with whatever values are as reason. Foreclosure is foreclosure. So the courts will allow the foreclosure to proceed generally. When I use generally, because I just don't have an exact example to give you, but every foreclosure I've had has always proceeded. So if there's a lot of equity in there, then they go into a redemption period. And during that redemption period, it could last anywhere from a couple months up to 6 months. The reason why it could be a few months or a lot is based on equity. If there's no risk to the lender and the risk is on the borrower because they got a bunch of equity, the court's going to give them 6 months to either refinance it, sell it, or do absolutely nothing. And at the end of that 6-month period, if they haven't refinanced, sold, and have done nothing, then it gets listed for a 90-day period. That's a judicial listing in that case. And that's when the courts are forcing it to be sold, as long as it's within a certain price point of the listing price. And the listing price is based off the appraisal. Now, let's say during that 90-day period, the borrowers don't let you in, which they could block it the whole time. At the end of that 90 days, if you haven't sold it, that's when the actual foreclosure takes place. And the property will go in your name subject to any equity and rules of the sale. And this is where your risk comes in if you're second. Because if you're a second mortgage holder, you now have to get financing on that first mortgage and be able to find out how to. You need to be able to sell the property yourself, but the first mortgage lender or the bank might say, hey, I'm done paying you out. And if that doesn't happen, that's now they start suing you. So when I mentioned about the financial assistance that sometimes I offer, it could be either based on monthly payments that need to be cleaned up, or it could be we're going to foreclose and now we have to write a bigger check to take it out. Because when you use the example of 100,000, for example, in Alberta's marketplace, when you focus Calgary and Edmonton mainly, it's a high chance those are going to be second mortgages just because of the dollar size versus the average house price. So just to keep that kind of as a side note, you'll get a higher interest rate, but there just is those things you got to factor in. Now, let's say that you've got 100,000 and your friend's got 100,000. You can co-lend together under a first or a second or so on. But when you're co-lending, now you've got 200,000 to work with. as a bigger number, that's when you can start getting into the firsts a little bit better. Like I did one that funded last week that had a $300,000 first and a $50,000 second, for example.
Oh, we're talking a lot about worst case scenario. I think we said foreclosure maybe 17 times in that. And people listening will be like, why the hell does this sound like a good idea? This sounds like I'm just expected to fail. Why would I trust you to lend money? This sounds super risky. So I like you because you talk about the worst case scenarios because you learn more from that. And that's what you look out for. But can you go over realistically what are the most common transactions and what does it actually look like most of the time? The best case scenarios that are real that you put together?
So I do hundreds of these loans a year. Currently, I have 3 foreclosures, one that's wrapping up, another one that's starting just because their first is going to be due in August and I don't want to renew. So I'm just giving them notice that this is what's happening with it. I don't have very many collections. I underwrite these well enough that the payments get made because the reason why is if I do it right up front, then I don't have to work on it for another year till the renewal comes. Most of these loans are planned and targeted for the bank to take it out as a refi. So that's where we plan them for a year or two or whatever it could be. And those payments are made quite well. And the reason why I'm using quite because I'm going to say it's perfect and then all of a sudden I'll give you a bad one. But there's plans for them. We're dealing with homeowners. Homeowners in Canada versus homeowners in America are two different. And I'm not saying that a homeowner in America is less of a person, but we treat our homes and so on much more serious up here. Because for starters, 2 weeks ago it was like 80 below. So where are you going to stay? And it's just the culture that Canadians are. That
even something as small as I used to live in the States for a couple months and people wear their shoes inside their house. Not everybody, but a lot of people. And it's just, when do you take them off? Is it when you're getting it? I don't know. It's just random to me. And they have carpet on the floor and they're wearing their outdoor shoes inside, which is just crazy to me.
Bugs or something, who knows? Oh. And I've got consistent flippers that contact me quite often. I got another house, where they'll keep it and do a BRRRR. I've had people from Ontario that have bought in Edmonton, for example, because they can't afford a Toronto home. And they'll go do a BRRRR, keep it, suited, it's rental. And then they've come back to me after the market's changed and borrowed maybe $25,000 as a second mortgage behind the bank. Now, in this case, I'm generally over 80%, so I'll do those myself. But when they take that $25,000, they're going to buy another property. They're not doing it to go to Vegas or anything like that. So there are those good ones too. And I've got one here in Calgary that they borrowed, I don't know, I can't remember, call it 70, 90,000. They're putting a double detached garage in, suiting their basement. They're going to refinance with the bank. Mm-hmm. So in that case, they need to use private because the property value hasn't gone up enough for the bank to say, yes, I'm going to give you all the money. And they don't want to do the construction part or the rental part anyway.
Yeah, so you obviously have a lot of repeat borrowers, and I know that you have a lot of repeat lenders as well that say, hey, this worked out great the first time. Can we just keep recycling this money and have that grow? As I mentioned at the beginning of this interview, everybody wants their money to grow, but some people think that being a landlord is too much effort for them. They don't want to deal with tenants. Some people don't have faith in the stock market or, God forbid, crypto, long term at least. So I think you're a really good middle ground because your money is still getting invested in real estate. If I'm lending on a property, I can still go touch it. It's physically there. My name is on title. And it's borderline like a bond because it's a fixed interest rate that I'm getting and a fixed term. So it's a lot more dependable than putting it in stocks when, I don't know, maybe the market's at a downturn like it is right now. So I think it's a good alternative for people that want to grow their money but are uncomfortable with the traditional ways of doing it.
Yeah. And here's why I love the lending. Like I'm sold on it completely for many reasons. I think the stock market, you can make a lot of money. Like I've got family that's in it. They do extremely well, but they are in it. That's their niche. They understand it better than somebody like me that's not into it. The other thing is my wife, Sabrina, has a toolbox and it has her name on it. And I say, is your boyfriend coming over? Because he'll come and do little repairs and stuff. I am not into that stuff. So when I go and lend money, it's so much easier. I get the cash flow payment, which is like a rental payment, but I don't have to worry about the vacancy, the
Mhm.
toilets, the trash, or anything that and
Yeah.
repairs. Now, if you look at a real estate boom that's taken place in Calgary recently and is going on in Edmonton, yes, the landlords are making more than I am right now. But overall, generally, if I'm getting a double digit return consistently and getting paid, who is making more? I don't have to do upgrades. I don't have vacancies. I don't have move outs. I don't have complaints. I don't have to go to court in a sense of they didn't pay me the rent and let's hope I'm going to get that month or two back. When it comes to private lending, you're getting it back if that equity's sitting in there. And people, when you look at from a rental standpoint, you care about the property the most, not discounting that tenants don't. But when they've got 80 or 100 or 200 grand on the line as a property owner, they care and those
Mhm.
payments are getting made. And I'll tell you, I have payments that are upwards of $5,000 to $6,000 a month from people that there's no way the bank's going to come along, but they make those payments. And when I say not, they're not going to come along. It's just, yeah, they could be self-employed or credit or whatnot, but it's just, it's paid. The other thing that I like is a stock might go up 10% this month and you think you've made money and then next month it comes
Mhm.
10%, you break even. When you have a mortgage payment, when you're paid, that's your profit. And then you can go on to the next month and wait. I've got some seniors now because we've been lending quite a few years and it goes back to my real estate days that they're in Florida sitting on the beach part of the winter and he just wants his cash flow so he doesn't dip into anything else. And I don't know whether he does anything in the stock market, to be honest with you. We're not that close, but quite often I get a phone call. Hey, I've got some more money. What can you get me? Now, obviously, his interest rates are more like single digit because he's a little bit older and he just leave me alone, give me enough to take care of my wife and I, and the kids can deal with the rest later.
A parallel I drew of what your job basically looks like is in my head, you're like the money version of a property manager. And
Yeah.
then if I was lending money, I would be the landlord slash buyer slash owner. And I would say, hey, take care of my asset for me. Can you screen and find somebody who would want to rent my asset from me? And then can you make sure that money is coming in and that I'm getting my cash flow? And you deal with all of that. And then, of course, the borrower is the tenant, basically.
Yeah.
And as you said, I don't have to worry about getting a call because there's a leaky faucet or the wax ring on the toilet needs to get replaced. And it's just, it seems like a very good, clean alternative for not having to put as much time into it. It's very passive compared to being a landlord.
It is now a negative. Not I've been focusing a lot on the negatives because
Mhm.
honestly, you do this. You lend with equity and you get your payments. The rest is history. You'll see how enjoyable it is and no stress. But let's say that somebody does have that property that the toilet leaks or the faucet leaks. I don't worry again if the property floods because I've got insurance on on the home. But mainly, if I've got the equity and the property value goes up, somebody that wants to fix up a home would love to get that opportunity.
Mhm.
And going into this insurance, so when you go and close with the lawyer, we get insurance in place. And depending on if you're first or second, there's a first loss payable and a second loss payable. And what that is, the insurance coverage has you listed as the second loss or the first loss payable. If you're with Olympia Trust, it'll say Olympia Trust. But where I'm going with this is if the property burns down or has any environmental issues or whatever, as long as
Act of
insurance.
God.
Yeah, when those happen, the insurance company will actually pay you directly your cost, so you don't have to go chase it with the borrower. Now, in that case, it's a must that they get the insurance on it. I do get letters from time to time that insurance has lapsed or they haven't made a payment or they've changed to different companies. As a lender, I get registered mail from the insurance company that says, look, you got 14 days or 30 days to get paid out or to get this corrected, or we're not going to insure the property anymore. Most of the time, when I contact the borrower about it, there's a story behind it or they fix it. But if not, we have to put insurance on it and make that payment, get the house insured for, again, if there's a fire or flood or whatever. And
Mhm.
when that happens, we can start foreclosure and you can recoup the insurance cost. So it's not gone. Going back to a stock market, if there's an expense, generally it's gone. With the lending, it's asset and you get to collect it. And the other thing is I'm not old, but I'm getting a little bit older. So we're starting to travel more and just do different things. And it's easier collecting e-transfers and automatic debits when you're in another country than checks as well. Not that tenants don't pay with checks. It's just perfect.
If somebody is interested in lending, I'm curious, is there a minimum amount of capital that is required for you to be okay moving forward with them?
So there's the minimum nowadays is higher than before because the loan sizes are larger, is really it. I just mentioned that I did a 300,000 first with a 50,000 second. That 50,000 second is rare to get that small nowadays. Another one I did this week was 85,000. There's a 75,000. So if that kind of gives you an idea of numbers. And then I've got 150,000 second, first 525,000 I recently did. There was that 300. There's another one that I did in Calgary that I think it was 390 or something is what it came out to. So you can get an idea what's the price point of the
Well, I
house.
guess a better way to frame it is if someone's listening and maybe they only have $5,000 right now,
Yeah.
at what point at what point of that money growing would be like a pivot point where they're like, okay, now I can talk to Jason about this. What is that number that they can now bring to you and say, I have this much. Can we do something together?
Gotcha. You pretty much need 100,000 or more just with the volume that I'm doing and the type of transactions and so on. What it comes down to mainly is if you've got 100,000, for example, you've got enough money to withstand a storm yourself, if you will. If you only have 5,000, forget the whole equity and everything, but you don't have the financial whereabouts to handle a problem if it goes on.
So that was actually my next question for you. Let's say that $100,000 that I've invested or saved, whatever, I have $100,000. If that $100,000 is all I have to my name right now, how much would you recommend I further invest or further save up for so I have that cushion myself and I'm not lending out every penny that I now have?
Yeah. So in this particular case, that's where we talk and find out what your goals are, where you're at, where the finances are at. Talk a little bit closer on what you need as a safety pot to the side. This is where maybe I get involved and give some financial assistance. Maybe I co-lend with you, or maybe we take a smaller loan and then leave that buffer. But when you talk about a TFSA, for example, whether you've got 50,000 or 100 or 200 sitting in there, you don't want to pull the money out anyway, is the truth of it. With that, you want to look at money on a line of credit or some other way of accessing it, is the truth of it.
And then I guess the last thing I wanted to discuss was the difference of TFSA RSP having that $100,000 in this case in cash, if I'm pulling it from a HELOC. So the actual lending process is the same copy paste, but the simple part and the quick part at the beginning is where you're pulling that money from. We talked about the TFSA and Olympia Trust where you just liquidate and then transfer. But is it the same for an RSP? And how can I use my HELOC on the equity on my house to private lend?
Okay, so the RSP, LIRA, TFSA, and so on, those go to Olympia Trust and they handle it between their trust accounts and the lawyers to fund it. And then to collect it, it comes directly out of the borrower's bank account into Olympia and then gets registered back in your TFSA. So that's how those ones work. When it comes to a HELOC, you treat that like cash. If you have the cash, great. If you have to take it off of a HELOC and it's 100,000, that's treated as cash as well. In those particular cases, you would send those funds directly to the lawyer, and then from there, the lawyer would send it over to the borrower's lawyer to close. Payment wise, would come back through either an e-transfer or a post-dated check.
So let's say I have a primary and I have 40% equity in my home now. Why would I want to lend out that 20% extra equity that I have available?
The extra bit that's in there, for one, you would have to talk to an accountant about your taxes because in some cases, depending on how you borrowed that money, you can write off the interest rate on the HELOC, and then your profit margin on the spread is what you only have to pay tax on. Now, I have some landlords that'll go put one of those readvanceable mortgages on their property because they might not be able to qualify for another home, or they might need to wait up to get the down payment to do. So they'll lend it out and they'll take the cash spread, put it towards the mortgage again, and it's like adding another garage to a house or adding another suite because they're getting that cash flow.
So let's
Now, if
put
it's on,
some numbers on that just so people can understand. So let's say my HELOC is at, I don't know, what should I say, 5%, just for easy numbers?
sure,
Yeah,
yeah,
so my
just keep it
HELOC's
at
at
20%.
5%, but I'm
Yeah,
renting or lending my money out at 10%. So I now have a 5% interest spread.
yeah.
That's what I'm profiting. So I can either put that back into my house to pay it down faster, or as he was saying, I can use that 5% as like extra cash flow and kind of pseudo make a suite or an additional income on my property without actually having an extra tenant or an extra lease on there.
Yeah, that's exactly it. And if it's on your primary residence, that's where you really got to watch the HELOC interest, talk to your accountant because it's your own home. But like I know some of my investors, they'll put small HELOCs in some of their cases. It pays the land tax, the utilities, the house insurance, and they're living free now, if you will. Or you can use it to offset your own mortgage payment and just speed it up. I've got a married couple that are investors up in Edmonton. They bought 3 up downs. They were at 80% on readvanceable HELOC mortgage. Their house was roughly 50% paid off. I You'll have to bear with me. This was before COVID stuff. There was about 250 or so in an RSP. Anyway, based on the readvanceable HELOCs they have, based on what we could get from their primary residence, they were able to pay these mortgages off in 14 years. And the reason why is they took the extra cash, applied it to the debt, and then as that debt grew, they got access to more. And to tell you the truth, in their case, with those 3 up downs that they have, the time they get those things go really chunking along and they've got the equity in it, it's like having 6 because you've got the tenants paying a mortgage and then you've got all this cash that you're getting the interest. And then at that point, do you really need 6 or 12 properties, or do you need to get a few good quality ones that will increase in value over the years stronger than others and still give you the cash flow you want to retire with?
Yeah. On
Yeah.
a final note, you're down in Calgary, which I learned the other day. I just always assumed you're in Edmonton.
Yeah.
But you were telling me that you're not very interested in lending in Calgary right now. You're way more interested in Edmonton. Can you explain why?
So I am interested in both cities, but there's a different, we have to watch the loan to value and prices in Calgary more than Edmonton at this exact moment because Calgary went through a boom over a couple years. So the prices went up and we haven't had our correction. And now Edmonton, you're getting the rush of the competing offers and the values are increasing. So we want to be able to watch that we don't go to the peak and then start lending a high advance because you get that correction of 5%. If you were at 80, now you're at 85. And we budget for that anyway, but that's one reason why I prefer Edmonton at this point over Calgary, just because we've had that run. But again, it does come down to the type of property more than anything, location and borrower. On that note, apartment condos, I don't touch them. They're too risky. They're the last ones to go up in a boom and the first to go down. Townhouses within reason. But the nice thing is the detached property or the half duplex. Those are the ones that the guy's really after, right?
Yeah.
And really what it comes down to is it's control without ownership. They're going to the hardware store to get the paintbrush on the beach waiting for the first of the month.
Exactly.
You
That's
know?
what I mean. It's so passive. You do not have to go there and deal with the tenants or fix the plumbing or like your job is done. You are the money partner and you do not have to get your hands dirty or spend any time. And me as the lender, if I were to lend money with you, you are the one who is going to be chasing them down if something goes wrong. So everything is taken care of for me by you.
Yeah,
Which I think is
100%.
awesome.
And like I get asked, how do I know? How do I know? And I have investors that text daily, hey, I've got this. Do you have anything? And they do that because I've proven myself and they love the game, right? You know,
Yeah.
and the truth of it is interest never sleeps. That's the other thing. That puppy ticks. It doesn't stop. So it's enjoyable that way as well.
Yeah, everybody heard you're not wealthy unless you can make money in your sleep. And this is a way you can do that. You can literally make money while you're sleeping or sitting on the beach getting your suntan on.
Yeah, exactly. And the other thing is, would you rather have $1 million or $10,000 a month? Because the million you can spend, the 10,000 a month just keeps coming and you can correct your errors each month and reset, right? So it's cash flow at the end of the day. That's why people like the real estate. It's cash flow and appreciation. It kind of hedges against inflation. But the other thing with these loans is you've got control. you've got cash flow and you can play off of it. And quite a few investors I deal with now, they do those readvanceable HELOCs because they're maximizing their position within their real estate to get the cash flow up. The other thing is they use their RSP if it applies, because some self-employed don't have an RSP because it just doesn't financially make sense with your taxes. But where I'm going with this is generally everybody has a TFSA, and that TFSA, you don't want to be 70 or 75 and start taking money out of it. You want to leave it to grow all the way to the end, because again, it's tax free. And once it grows to a certain snowball size, it really gets going. Where you go and look at an RSP, roughly 71 or whatever it is nowadays, you have to start pulling it out and you get taxed. You get a little bit older, you've got that up down rental. Well, you get tired of the tenant, or you want to travel more, or whatever reason, you don't want the maintenance. You can sell and go do the loans again, and it's a perfect retirement game is really it.
I think you've just been in the game so long that you know all of the ways it can go wrong, and that's so valuable because you can forecast and use that to protect your clients and yourself as well, right?
Yeah, 100%. If I've got that, you're more happy. And again, it takes stress off my side as well, that I don't have to worry as much, right? Because my thing is I want the payments made for you. It's a lot more fun. Obviously, if I got to collect them, like I say, it keeps me in tune, but there's not many I collect. Like I say, we do hundreds of these a year.
That's what I love about literally any money game out there. Once you start really getting into business, you realize it's not a sum zero game. It's not I'm winning because you're losing. It's like we are only going to profit if this is a double win or a triple win or quadruple win. So there's so much money out there, and you're not taking from anybody if you're profiting. You're actually profiting the most when you're profiting other people.
Yeah, exactly. And that's how you close a transaction in 18 hours. You've got the relationship to get it done is really it.
Yeah.
So
awesome. Thank you for your time. If someone's listening and they want to reach out to you, how can they do that?
If they could just look at you tell
the
them.
description below. All right. Yeah, I'll put your information in the description below. And yeah, that's all I have for you. Thank you so much, Jason. This was amazing.
No, thank you so much as well. Hopefully it all made sense and I wasn't too negative, but at the end of the day, I just like to talk about the negative because honestly, it's easy to see the positive. It's the negative that you always find out sometimes when it's too late. So I'd rather focus on that than that, hey, what if Jason's lying to me? What if if something happens to me and I'm gone?
I love it because that was an opposite of the sales pitch. Like you could have sales pitched me and say it only goes well, and I can promise you these returns, and it always goes right, and I'm the best, and you are the best. But you went through all of the ways it can go wrong, and I think that's way better. And you're obviously come across as a stand-up guy, and you know your stuff, and you're genuinely looking out for people.
Yeah, for sure. No, definitely. Yeah, interest never sleeps.
Never. Awesome. Thank you so much, Jason. It's been a pleasure. I hope you have a wonderful day.
You too. Take care of yourself.
All right. Bye.
Okay, bye.
Thank you again to Jason for joining me. I think private lending, creative financing, whatever you call it, is very, very interesting. Even at the beginning, you saw there that he was talking about different ways you can structure a deal. And the sky's the limit as long as you know what you're talking about. And I know we talked a lot about the risks of private lending, but you also saw how he counters those risks with incredible due diligence. As with anything, it is always risky until you educate yourself. So please do your due diligence before entering one of these deals and make sure you're going with a qualified professional like Jason to advise you. Thank you for watching. Thank you for sharing your time with me. I hope you have a wonderful day. Bye for now.